They waited until you were asleep. It's an old tactic, a dirty tactic, but one that has worked for decades. Last night, while New York was dark and London was pouring its first coffee, they pulled the most dangerous lever in the silver market. They didn't dump metal. They didn't open a new mine. They didn't fix supply. They changed the rules. If you woke up this morning and saw red candles, if your stomach dropped and you thought, "Here we go again," stop. Breathe, because what you're looking at is not a market crash, it's an act of desperation. Overnight, the CME exchange, the supposed referee of the silver market, raised margin requirements on silver futures by a staggering 50%. That means it suddenly became 50% more expensive to hold a silver position. There was no warning, no vote, just an overnight decree. This is known as a margin nuke, and it's designed to do one thing: force selling. Let's put this into perspective. Yesterday, controlling 5,000 ounces of silver required about $12,000 in margin. After the rule change, $18,000. Now, imagine you're not just a small investor. Imagine you're a hedge fund holding 1,000 contracts. Yesterday, you needed $12 million to maintain that position. But at 2 in the morning, the exchange suddenly tells you that you now need $18 million, and you need it immediately. Where do you find an extra $6 million in the middle of the night? You don't. So the system does the work for you. It sells your silver, automatically, at whatever the market price is. This flood of forced selling pushes prices down, not because the fundamentals of silver have changed, but because the house decided to change the buy-in at the last minute. This isn't the first time they've pulled this move. This exact tactic crushed the silver market before. Back in 1980, prices collapsed by nearly 50%. And more recently, in 2011, silver fell 30% in just a few days after repeated margin hikes. The big banks were counting on history to repeat itself. They were expecting panic. They were expecting a total collapse. But this time, something completely unexpected happened. Silver didn't crash. It dipped for a moment, it paused, and then it held its ground. It ended up down less than 1%. The margin nuke failed. So, why did it fail this time? The answer is simple. The buyers in the market today, not the same buyers from 2011. This rally isn't being driven by leveraged speculators who are easily shaken out. It's being driven by massive industrial users, sovereign buyers, and a wave of cash-paying demand. Think about it. Tesla doesn't buy silver on margin to build its cars. Samsung doesn't get a margin call for the silver it needs in its electronics. Governments stocking up on precious metals don't panic sell because of a rule change on a futures exchange. So, when the paper traders were forced out of their positions, the real, physical buyers simply stepped in and bought the dip. What happened next was a classic bear trap. The price was pushed down just enough to scare the weak hands. Some retail traders sold. Short sellers, smelling blood, jumped in, betting on a further price collapse. But every single dip was instantly bought up. This wasn't driven by emotion. It was driven by algorithms, by corporations, and by sovereign funds that saw a discount. In a matter of hours, ownership of these contracts quietly transferred from the paper hands of speculators to the diamond hands of long-term holders. The timing of this move was no accident either. It happened on a Friday for a very specific reason. The banks fear the weekend. When Western markets close, their control over the paper price shuts off. But as the West goes to sleep, Asia opens for business. And buyers in China don't fear margin hikes. They see them as a sign of weakness in the Western financial system. A discounted price on silver just as the Asian markets open is an invitation, not a warning. So now, the regulators and the banks are trapped. If they do nothing from here, silver is likely to keep rising. But if they try to intervene even harder, they risk breaking the entire paper market completely. They can try to crash the paper price, but they can't create physical silver out of thin air. And once the price of paper contracts and the price of real, physical silver fully decouple, they will lose control forever. This forces you to ask yourself a critical question. Are you holding silver just to make more dollars? Or are you holding it because you understand that the dollar itself is broken? The paper markets are screaming at you to sell. But reality, the physical world, is whispering to accumulate. You have to choose carefully. The margin nuke didn't end this rally. It just reset it. The excessive leverage is now gone. The weak hands have been shaken out. The floor under the price is now solid. The short sellers are trapped on the wrong side of the trade, and the path towards 70, 80, or even $100 silver is now clearer than ever before. They fired their best weapon. They used their most powerful tool to crush the price, and it didn't work. If you understand what just happened in the silver market, you are already far ahead of the crowd. Thank you for watching. If you found this breakdown valuable, make sure to like this video and subscribe to the channel for more updates. We'll be tracking the situation closely, so hit that notification bell to stay informed. See you in the next video.